There is 100% certainty that you will not achieve a sufficient retirement based on your, just do the math. You will not achieve it based on bond market returns for exactly the phenomena you just said. So what is your option? That disease is killing you. Once you've had the ability to transfer money whenever you want it, as fast as you want it, to ask people to go roll that back, I think the probability of that is virtually zero. Prediction markets are better at predicting interest rate hikes and cuts than the top pollsters.
I'm here with John D'Agostino. He's a head of strategy at Coinbase Institutional, and joining me to co-host the show is
Bonnie Chang.
Welcome to the show, John.
Good to see you. Good to see you, David. Good to see you again, Bonnie.
You're very passionate about the market structure bill. What is it that people do not understand about it yet?
I think it's a very wonky thing, but I think people underappreciate how big of a deal this is. We don't do new market structure legislation willy-nilly in the US. It usually happens when there is a catastrophic disaster. It usually happens when you have a great financial crisis of some type of massive explosion where moms and pops, voters are dramatically affected. So market structure is usually a negative reactionary thing. The fact that you have this asset class, which from an institutional perspective has really existed in modern form for 7 or so years, right? It's existed for about 15, technically, about I'd say 9 to 10 from a retail perspective, and really 7 years. The fact that a brand new asset class is getting market structure legislation, not because of some massive blow-up, but because there's a recognition of how impactful it's become in the US economy. We should all be incredibly grateful that we have the opportunity to live during this time. And for those of us who work in the asset class, we should be very, very grateful. So I understand there's negative crypto sentiment. If you look at the broad indices, you look at Twitter or X sentiment, I don't see it. I just see an extraordinary achievement for this asset class. Sorry, go ahead.
For someone that doesn't really know what's going on, what does it really change?
Sure. Well, I mean, look, there's been a couple of reasons that large institutions have said I'm going to do the work. I like the technology. I like the asset class. I can't push investment capital into that class yet, or customer capital, or I can't allocate or hire out a team. By the way, they're all hiring out teams. I've gotten all the phone calls. All the folks who are screaming and yelling about clarity are secretly hiring out very, very senior teams. But I understand why, if you're a highly regulated entity, really committing to the asset class has been challenging because you have this kind of regulatory overhang. We don't really understand. The term of art is regulatory, lack of regulatory clarity, which is a bit silly because many existing legacy industries operate without perfect clarity. But it's understandable because there's just no framework around it. So Genius provided a framework for stablecoins. What happened? Stablecoin adoption has been just a raging bull market. So you're looking at that and you're saying, okay, now that narrow niche of stablecoin, once it achieved regulatory clarity, by the way, not perfect. No one was thrilled with the Genius Act. When it came out, there were lots of naysayers about it, just like with this latest draft of clarity, but it provided a framework that you could operate within. And then we saw just massive take-up, hockey stick take-up. So the institutional players are looking at that and saying, if that's what happened when we got this tiny little, on a relative comparative basis, tiny little bill, imagine what happens when we have broad-based market infrastructure bill, even if it's not perfect.
Can we just talk about stablecoins for just a minute? Let's back up and think just macro.
Sure.
Now, I keep hearing the narrative, and I'm pretty sure Bonnie has as well. Stablecoins is going to change the future of finance. We all need stablecoins. It's a better form of conducting business, B2B or even B2C. Yeah. Bonnie and I were just talking about this offline about how, according to some surveys and polls, 37 Americans don't have $200 saved up. 35?
Sorry, 37% do not have
$500 saved up.
Okay, I believe
that.
So
for those people, cross-border remittances are not the priority in life.
That's fair.
So who are stablecoins for?
So stablecoins are for anyone who would like to get clarity around where their money is within seconds or hours versus days. And I would argue that while cross-border payments are not important for that person with $500, I would argue that that person with $500 is receiving a transmission, a wire transmission, or a money transmission, that it is even more important for them to achieve clarity on whether or not they have that money within seconds, hours versus days. I'd argue that it's more important that they be able to send or receive that money for pennies versus tens of dollars. I just sent a wire from a major US bank to a major US bank, and I was charged $30 for that transmission.
Kidding.
And I'm a good customer of that bank.
US dollars you transferred.
I transferred, I'm not gonna say how much.
Yeah, I know.
It shouldn't matter.
Right.
But I transferred US dollars.
Wow.
Doesn't matter if I'm transferring $5 or 500,000 over the same wire system, the same electronic system. I was charged $30, and I am a good customer of that bank. So that is a massive problem, whether you have $500 or $5 million.
Sure.
So I think about it this way. I think about it very simply. My mom asked me this all the time, and I said to her, once you've had the ability to transfer money whenever you want it, as fast as you want it, to ask people to go roll that back is like asking us to go back to watching movies when the movie theaters tell us we are allowed to watch movies. I think the probability of that is virtually zero. So I understand that folks with smaller amounts in the banks, that maybe they're not as comfortable leveraging new technology with that smaller amount of money. I get it. Once they experience it, they will never go back to waiting for banker hours.
I want to ask you about yield on stablecoin. Don't you want to keep the yield? Isn't it better for Circle and Coinbase and all that issuers?
We've been very clear. Brian Armstrong is arguing against the selfish interest of everyone who works at Coinbase. We believe, so would I rather, in the short term, from a greedy perspective, yes. In the long term, I'd rather have a smaller piece of a massively larger pie. So we decided to build our, we want to give that yield back because we think ultimately that will inspire not just 250 or whatever, 300 million stablecoin users, 3 billion stablecoin users. So we think the idea that you are paid an interest rate from the US government that is roughly 4.5%, and you give your customers 10 basis points of that is inherently problematic. And so we think that if we can flip that around and push the majority of those rewards back to the user, which is what we do currently, then that just means the pie is that much larger. So our goal is to get 1 billion people on chain. You get 1 billion people on chain by solving a problem. 10 basis points of interest in your checking account is a big, big problem. People say, oh, the difference between 10 basis points and 2.5%, 3%. Compound that over the lifetime of a child. That's a car. That's a year of education. That is inherently meaningful compounding effect over 20 years. So that's what we're trying to give back to the American consumer.
Before we continue with the video, let's talk about today's sponsor, Delete Me. Now, there's an entire industry built around collecting and selling your personal info. Data brokers collect information such as your name, address, and phone number, then package and sell it to third parties. Delete Me is designed to help reduce that exposure. It only takes a few minutes to set up, and they handle all the work in the background. They identify where your data appears, verify those listings, and submit removal requests to hundreds of broker sites. They also keep monitoring since these listings can come back over time. I've been using Delete Me for over 2 years now, and they have reviewed over 325 listings of my information. This saved me over 12 hours of searching and reviewing it myself. The reports show exactly what was found and what was removed, which makes the process transparent. Scan the QR code on the screen here or go to joindeleteme.com/DavidLin, link in the description down below, and use code DavidLin for 20% off. Now back to the video.
I hear two very different voices on stablecoin. One is stablecoin issuers are not going to be as profitable because of this. And the second is the pie is going to be so much bigger that it doesn't matter.
I believe in the latter part. So when I got first started in finance, my first job was to electronify the open outcry system in the New York Mercantile Exchange. And I got lots of arguments as to why we shouldn't do that. And there were good arguments, by the way. It was working really well. Everything, no trade breaks. We priced the most valuable commodity in the world, crude oil, worked fantastic. What was hard for them to understand, because they only had grown up in that structure, was that we could septuple or quintuple the size of that market by going electronic. And I don't blame them for that. It is hard to imagine a world that is that much larger than the world you live in. And when all you see is things working really, really well. Why are you upsetting the apple cart? We're the world's most valuable commodity. The price discovery is amazing. We were trading trillions of dollars of notional crude oil, if you consider the derivatives. Why would you mess this up? This is going really, really well. That market's now 10 times the size of what it was back in 2002 because of that evolution of technology. So I don't begrudge people who want to say, hey, hold on, things are very liquid right now. It's working. The US is the envy of global capital markets. I completely appreciate that perspective. It can be so much bigger if you move from T plus 24 hours to T plus 24 seconds. And it's difficult to appreciate that in its current form. Unless you've been through that trend. I've been lucky enough to have gone through one of those transitions. So I see this coiled spring that is this shifting from 10, 20, 30x lower latency times. It frees up hundreds of billions of dollars of capital, it lubricates the capital system, and it continues to make the US the envy of all capital markets.
There was, last year I was paying him and he said, I only take USDC, okay? In Asia, we use a lot of USDT.
Yes.
And he said, I only use USDC. And now I'm thinking, okay, if in this region, you can only use USDC, and now you're welcoming a lot of more competition by expanding this pie.
Yes.
How does that affect Circle and Coinbase? And
so look, I give full credit to Tether. What my understanding is they were all sitting in a room one day and said, let's monetize US Treasuries. And that was a brilliant, brilliant idea. We talk about, tokenization taking off. That is tokenization. We don't think of stablecoins as tokens, but that's what they are. They're real world asset tokenization. So I give Tether all the credit in the world. I don't think this is a monopoly. I think this is an oligopoly. I think you have 2, maybe 3 or 4 dominant global stablecoins backed by US Treasuries and other similar assets that dramatically and rapidly transform and modernize the payment system. So I think, again, the global pie is much larger than any of us can imagine. So I'm not worried about cannibalizing Tether or USDT cannibalizing USDT. I actually think the rising tide carries all ships. I think it's probably healthier for the global economic payment system that you have 2, if not 3, options available. In general, investment community participants, traders, whatever, payment participants, they don't like monopolies, they like oligopolies. And there's reasons for that. You want diversification. You don't want too much diversification because the fractured liquidity is less useful liquidity. But I think a world of USDC and USDT, one being dominant in the East, one being dominant in the West, that's a healthy world.
Speaking of yield, can we talk about asset allocation for just a minute? The bond market in the US has been in a structural bull market since the mid-70s, where the double-digit interest rates on the 10-year yield now down to, at a certain point when it went down to near zero, Did you think to yourself, this is the end for the 60-40 portfolio? How do you go up from there when the yield's literally at zero? And now, by the way, since the last couple of years, the bond market's just been not doing very great. And so now people are thinking about ways to substitute the bonds in the 60-40 portfolio with something else. So I know there's a lot to unpack there, but
it's a great observation, and I think it's part of the sort of cultural zeitgeist that gave birth to blockchain technology, right? So there's a growing realization amongst I think more young Americans understand the relationship between interest rates and the security of their retirement than ever before. And more young Americans understand that you cannot rely on a savings account yield to provide for you an effective retirement. Yeah. And what that naturally gets you towards eventually is you have to take on risk assets. Then the question becomes what type of risk asset. The only thing riskier than not taking risk, the only thing riskier than taking risk is not taking risk when there's 100% certainty the yield will not afford you a sufficient retirement.
Good job. Right? You're speaking my language right now,
it's
but
the riskiest thing in the world.
How do you say exactly that to a 66-year-old?
That's great. I got asked that question the other day, and I said, and I asked them, I said, if there was 100% certainty, right, 100%. So it's probably a bad analogy, but I use disease as an analogy. But sure. They got a 100% certainty a disease was going to kill you in 6 months, and someone came to you with an experimental thing that had a 50% chance of killing you in 6 months. You'd be every human being intuitively, of course I'll take that risk. Yeah. Absolutely, right? Why wouldn't I make that trade? That's a fantastic trade. So I'm saying there is a 100% certainty that you will not achieve a sufficient retirement based on your, just do the math. I can set the spread, Claude can set the spreadsheet up for you now in about 30 seconds using plain English. Yeah. How much do I have? What do I need to retire? What rate of return am I getting? Ask Claude those 3 questions, and it will tell you you will not achieve it based on bond market returns for exactly the phenomena you just said. So what is your option? That disease is killing you. What is your option? Their option is to take some risk. Take thoughtful risk, don't jump off a cliff. Don't say I have the security at the bottom of that cliff.
Yeah.
That's obviously a bad trade. But incorporating risk assets into your portfolio, it's insane not to consider it.
Where do we go for yield in 2027?
I think we'll start. I don't think my mom will be getting DeFi yields, but I think you'll start to see DeFi get normalized and wrapped and packaged through some form of intermediary that will provide some sort of vetting process for the quality of that protocol. I think that'll start to normalize. I think you'll see yield in wrapped assets and ETF type assets for Bitcoin and other wrapped securities. I think you'll get yield if you're a non-US citizen and it's difficult to access the incredible economic growth engine that is US economy. I think you'll get it through tokenized equities and wrapped ETFs. I would love to see a world where everyone on the planet who's able to scrape together $5 can bet on the US economic engine through some type of tokenized S&P 500 wrapper without having to go through the headache of advanced AML. I think that's an incredible thing for the U.S. government to get behind. It's a wonderful marketing program.
I'll pass it to Bonnie for now. When we come back, I have some questions on tokenization in the markets.
Sure.
Go ahead.
Okay, sure. Thank you. Well, we were just talking about token. She has more creative questions than me, so I wanted to switch it up. But anyway, the tokenization aspect. I wonder if the crypto industry through tokenization is cannibalizing themselves. Let me explain what I mean.
Yeah.
Just in the prior interview, we were talking about how Hyperliquid is now trading more in terms of volume, securitized oil, gold, and other commodities.
Yes.
Now, this just opens up the door to 24/7 trading on those particular commodities or any other real world asset. We're not actually putting money into layer 1s and 2s. We're actually just trading those commodities on the blockchain. Now, Get this, a lot of these securitization companies want to back their tokenization one-to-one, which means they have to buy the underlying first.
Yes.
Doesn't that just drive up demand for that underlying and suck capital away from blockchain?
I don't think, I appreciate your point.
Yeah.
And I don't subscribe to the notion that blockchain is competitive with the legacy financial system.
I see.
I think it is an upgrade. I do think it's an upgrade. But I think there will be elements of the legacy financial system that will work side by side with blockchain technologies for all of our lifetime and probably our children's lifetime, and that's healthy. You don't replace everything in your home at the same time as new technologies upgrade. So I think that if we can marry a traditional securities model in the U.S., which is the envy of the world, if we can start to see blockchain as an expansion of that securities model. That way, everyone in the world who wants at least the price, at least access to price exposure, can get access to price exposure. They may not get access to corporate actions day one, but these are evolutionary, not revolutionary in some way.
Right.
And it's really, really important that we figure out ways to marry legacy systems and blockchain systems.
Going back to your point earlier about you were using Taipei real estate as an example. How does tokenization not create the biggest bubble we've ever seen in finance?
Well, leverage creates bubbles, not distribution mechanisms.
Okay, elaborate on that.
Please.
So, an average home in Taipei right now costs 185 months of average household salary. So that's just an apartment.
Wow.
It's very, very expensive. Now, you see companies, do stock splits because they want it to seem more affordable for more people. Now, if we do the same with tokenized housing, tokenized homes.
We're starting communes? How are we all living in that home if we fractionalize it?
So you do not buy into this tokenized real estate?
I think tokenized real estate is useful because the legacy systems for recording real estate are just archaic and silly. I just bought an apartment in New York. I had to buy insurance to make sure that no one came along in 5 years and told me I actually own this apartment. Mm-hmm. That's just silly. That's just poor record keeping.
Right.
I don't subscribe to the belief that it's a longer conversation. I did he might hate if I name drop him, but Nuro Urbini, dear friend of mine, brilliant economist. I won't talk about his views on crypto because it's not fair to him because he's not here, but he's someone we should all listen to. I'll say that. Yeah. He and I used to talk and we did some work together on asset bubbles. And he's the king of that. And what I learned in that chance, I had to piggyback on his genius around asset bubbles, is they are an endemic part of markets. And so I'm not going to say they're good things, but I'm going to say they're like hurricanes. They just exist, and they're ways to cleanse out market structure. And so I don't think changing the distribution mechanism for how you buy and record a home is what causes bubbles. I think what causes bubbles is overexuberance and the existence of cheap leverage in a system. And I will argue that for healthy economic systems, they are going to continue to exist. One little tidbit of research that we discovered is during bubbly periods in assets, patent filings for technology with those assets go up 4 times.
Yeah.
And so another way of saying is, it would be wonderful if we could all be sober, thoughtful investors and dedicate resources to technologies that matter. But that's not how we do things. I pray for bubbles in medical technology, because during that bubbly period, so investors will get harmed, there's no question. Yeah. But during those bubbly periods, we have a step function in innovation, and so it's just how we invest as a species. We're quixotic. Until agents take over and remove all emotion, we will have asset bubbles in cloud. But it's not whether it's a tokenized distribution or a DTC security. That's not what causes bubbles. What causes bubbles is human nature. And so in some ways, bubbles are good because they inspire innovation. But I think that's why I think we'll always have some type of regulatory structure around it to protect individuals, because they can also harm investors.
Just final question for me is tokenization not just a form of leverage in itself? How is it different fundamentally from a collateralized debt obligation, for example?
So if you have a one-to-one back tokenized offering, there's no leverage incorporated, right? So it's based on the right now, I mean, you get implicitly, you buy a future on the New York Mercantile Exchange, you're 5-to-1 levered, right? And then you can go borrow on top of that. So we don't blame the technological mechanism. If you're concerned about asset bubbles and leverage, you really have to worry about the credit community. That's what causes bubbles, not the fact that we are writing it on a piece of paper or putting it into an Excel spreadsheet or storing it on a blockchain ledger.
Bitcoin started after a financial crisis, and it was because of all these wrapped and leveraged products. Now we're at a crypto conference talking about all these different financial products.
That's a great observation, right? Blockchain wasn't even a dream when that happened, and we found out that there were companies that were over levered 100-to-1 that were regulated and should not have been doing that, right? That was just illegality. That was just malfeasance. So this problem has existed since the dawn of time. I'm sure there was a bubble in seashells at one point when the cavemen were trading them. I don't think we ever get away from that. And I think even agents ultimately will have human characteristics that will be prone to momentum trading and irrational exuberance. That's just, we talk about crude oil and kind of where it sits now. Crude oil less than 3 years ago was negative. You had to pay someone to take delivery of the world's most valuable and important commodity, right? So, and that is a very institutional, highly credible, highly regulated market. And it was negative for a brief period of time. People are all like hand-wringing about crude oil being $130 a barrel. I was more worried when it was negative. What does that say about global demand and production? So I don't think we blame the system for that. That's just human nature.
I think off camera we were talking about AI companies trying to give you really, really, really good good offers, but you decline them.
Thank you. I hope my boss is watching. And look, it's super exciting. I love what they're doing in AI. And my daughters, my daughters have an AI quota every week. They have to produce at least 2 games with Claude about what they're working on in school right now, and then push those games out to their classmates.
Oh, I'm sorry. Your daughter is working with Claude in school. How old is she?
No, my daughter. I have a 9-year-old and a 12-year-old, and they both have no. This is me at home. I'm a tiger dad, except I'm Italian, so I'm a pasta dad.
Okay, the schools aren't for that. Okay, the schools aren't. Okay, yeah. All right.
No, they have a quota. Unfortunately, the schools are only teaching them that AI is scary.
Yeah.
They have a quota at home to produce 2 AI games, one on what they've worked on, one on what they will work on, and push it out to their classmates. And I think you're doing your children a disservice if you don't arm them with that information. So AI is going to decide to use crypto as a value transfer mechanism. We know that. That's clear. And so I'm skeptical that we'll have AI agents trading on our behalf as American consumers anytime soon, but I do think they will help organize payments for us. I think about the things I buy every month.
Why do you say that?
I think that the legal structure and the liability around making investment decisions, truly porting over investment decisions, maybe I'm being too close-minded, but it's the same reason I don't think we'll see driverless cars, as much as we should anytime soon. It's not that the technology's there; it's all of the liability and the infrastructure around it. That just takes time to change. But having my AI agent, pay for my groceries. I order the same groceries every month on Amazon. Having it put in the order automatically that I made last month, and then wiring the money, that makes perfect sense. And it will use stablecoins to do that.
My friends who go to tech conferences say every one of them is all about building AI agents now. So if you're an investor, which you are, how do you cipher the noise from the signal? Who's a scammer? Who's legit? How do you?
I have a quick rule of thumb.
What's the checklist here?
Any adult male dressed head to toe in a single fashion designer. That's a good sign of who a scammer is. That's the only way I know it. All of them have that sideways baseball cap, right? No, I think it's hard. It's hard now. I just got offered a pre-IPO offering of Anthropic at like $1 trillion valuation, and normally I'd laugh at that, but I had to really consider it.
$1 trillion valuation.
800 billion. Like, all the banks are selling. It's public information. I got pitched by my banker, and normally I would just laugh at a company, but how can you not take that seriously? I mean, when you look at the TAM, right? I'm investing more on the data center and power side because I like the picks and shovels model. But it's again, people have a hard time imagining how large these markets can be. And so I think, as with anything, as the advice I give about crypto, invest, a proportional amount of money relative to your risk appetite. I don't YOLO into anything, and I don't think anybody else should. But if you're being sober and thoughtful and you have a risk allocation that's reasonable for your wealth level, I think, the sky's the limit on these stocks. I mean, it's just, they're just extraordinarily, paradigm shifting technologies. It sounds cliche, but it's very, very likely that 2/3 of the planet will be leveraging AI in one way or another, and the backbone of that will be crypto value transfers.
Why aren't you taking an AI job then?
I have a great job. So that's simple. I enjoy what I do. I trust the people I work with, and I get to sit here and talk to great people like you. So I'm happy.
Do you think money is leaving crypto market and going into AI?
No, more prediction markets is the thesis, right?
Going to prediction market.
So I think, look, I have this theory based on my history and kind of idiosyncratic assets like commodities and crypto. I think to have a healthy market, you need different layers of different strata of investors. You need boring hedgers who want to just come into the market to offset their risk. You need long-term value holders. You need shorter-term value holders. You need institutions, retail, educated retail, non-sophisticated retail. And you need this sort of wild, wacky strata of just risk-chasing trader. And that tiny, and they're not a huge proportion of the industry. That strata does move. It follows trends. If that's the strata that wants to turn $1 into $500. So it is going to chase that over time. And that's okay. Because as you get more evolved as an asset class like crypto is, that strata becomes less and less important. They're really, really useful in the very beginning, and they're fueling a lot of what's happening in prediction markets. As prediction markets grow and evolve and more thoughtful capital comes in, they become less important and they'll move on to the next thing. They get you where you need to be in the early days, but they're not necessary as you evolve. And so I'm not that worried about that tiny portion of risk capital that was chasing, a meme coin that can turn, 10,000x over the course of an evening. Their natural home is in that next thing. And so I think that we've lost them to prediction markets, but that's not the core Coinbase user.
Going back to your picks and shovels comments, so if AI is a gold rush, who's selling the shovels?
Power companies.
Yeah.
Just the power demands are just, if you thought Bitcoin sucked up power, try training an LLM, right? That's and we just don't have enough. Remember, we have to do other things besides train LLMs with our power, right? We have to power dialysis machines too. So we have to make sure all of this stuff is available. Infrastructure plays, right? Our power battery technology, which is just, I had a physicist tell me why batteries are the hardest part in the whole power stack. Imagine a really strong Swedish accent. He said, he goes, John, in physics, we have a name for when you shrink power into a smaller and smaller place, a physical footprint. It's called a bomb. He goes, that's why ultimately battery technology is really, really challenging, right? If you wake up tomorrow and they say, we have a battery that can power your phone for a year straight, you should be very worried about what you're carrying in your pocket, right? That's a fundamental physics problem. And so that technology has to evolve. We have to be able to transport energy better.
Bloom Energy is doing that.
I've heard about them. Yeah, no, it's anyone who can crack that code is, anyone who can take a Tesla and make it 50% lighter is going to change the world.
Is prediction market gambling?
Some of it, yes. Yes, some of it, absolutely. Is it? But to be fair, is buying a penny stock on the NYSE who has negative earnings. Is that gambling with no assets?
Yeah.
That's faith. It's gambling.
Faith?
Right, it's gambling. Faith and gambling. Faith and gambling are very close. So I think we just have to be real. I think we have to have a conversation as a country about how we want adults to engage with these types of opportunities. Because it's never, you used to have to go to Vegas to place a sports bet. Now you don't have to. Now it's on your phone. And I think it's a valid conversation to have. And we should be open to that conversation. But we should also, the backbone of this should be adults should be allowed to do with their disposable income what they want to do. Like, if we never stopped an adult from getting on a plane and going to Las Vegas and betting everything on black. We didn't stop them. But now we're going to tell them that you can't do something similar because it's available on your phone. We have to have a conversation about that in this country. But I would say, I care less about that. What I care about is the fact that prediction markets are better at predicting interest rate hikes and cuts than the top pollsters. I care about prediction markets being really, really good at predicting crude oil prices. I care about the fact that if the U.S. launches a missile into Iran at 2 a.m. on a Saturday, you don't have to wait until Monday 9 a.m. to hedge that crude oil exposure on hyperliquid. That is what I care about. The gambling discussion will be had as a country and as a society, and we'll sort all that out. I know there's a very elegant legal argument about who has control over that. I won't pretend to be able to convey that argument. And we'll have that discussion. But in the meantime, prediction markets are showing incredible informational value that you should not throw out with the bathwater because you're concerned about the societal impact of gambling.
We know that prediction markets are very accurate when it comes to data.
100%.
But why is it accurate?
Because they are curate. Crowds aren't that wise. Curated crowds are very, very wise. And so there's a natural curation that occurs when you have a specific market venue, that people are drawn to it, and you get the best of all worlds. You get breadth of market, depth of market, and you get a degree of curation around that market. And that's when crowds are really, really smart.
Can you explain that breadth and depth?
So sure. So if you had, if you put a completely random 100 people in a room and ask them a really, really tough question about physics, solve this physics problem, more than likely probably aren't going to be able to do it. Now, if you have a completely random million people in that room, there's a higher probability they get that, they get closer to the answer, right? But still probably they won't be able to do it. But if you get 100 people in a room of the top mathematicians and physicists, they have a better chance of doing it than if you have 5. Curated large crowds do better and better at solving complex problems. Random assemblies of people, it's a coin flip. So, but I will say this, there is even value in knowing what large random groups of people do, because prediction markets actually don't, prediction markets are like futures markets. Futures markets on January 1st are really bad at predicting the closing price of crude oil on December 31st. They're not savants. They can't predict the future. But they get better and better as the year goes on, and they get better and better than random prediction. Day one, a year from now, a coin flip's probably as good as a futures market in predicting what the closing price of crude oil will be on December 31st. But as you get closer and closer to that day, they get better and better than a coin flip. Now, the time that's passed is not useless, because as a trader, I want to know the consensus at any point in time. So all of that information is incredibly valuable, but they're not magic. And so, but we want them to be active and liquid because we want that information. And then they do get really, really good and way, way better than random prediction at solving that problem of price prediction as you get closer to the event.
Let me just add to that if I may, John. So there's an element of financial gain involved that makes it accurate, because this is why some economists have told me that the reason polls on elections have not been as accurate.
No skin in the game.
As prediction markets is because those same people, the curated crowd, have no skin in the game when it comes to polls, and so they don't participate, but they participate in the prediction markets.
Nassim Taleb, another brilliant guy who hates crypto, but he's a brilliant guy, and we should listen to him. We should listen to people who have different views from us. Nassim Taleb talks about, I think it's Hamanoptera's law. I think it's that if you, at some point in one culture, the rule was if you were a bridge designer and the bridge collapsed, they buried you under stone. So this notion of skin in the game is extremely important. Couldn't agree more. Now, there are negative perverse financial incentives that can develop, but it's a delicate ecosystem. But the general, it is known that curated crowds scale in intelligence.
In Asia, there are a few companies building prediction markets, and they frame it as the information market.
I agree with that. It should be viewed that. I think we should think of them as information markets, not prediction markets. I agree.
Could you explain why?
Because, to your point, because polling was a good science when we didn't have the ability to gauge actual sentiment. When we didn't have people's opinions in digitized form. When we didn't have the ability, meaning Twitter, meaning X, right? When we didn't have the ability to get the X fire hose and gauge sentiment of very, very large groups of people. Calling up 1,000 people and getting a statistically relevant sample set was the best we had. So trading is always about using the best information available. No one has perfect. If you have perfect information, you're insider trading, right? By definition. So unless you have inside information, you're trading on imperfect information. And so it's all about just having slightly better information than my competitor. That's all I need. And knowing the views and beliefs, behind the scene, if you will, views and belief from 10 million people is better than interrupting 1,000 people at dinner and getting their non-unbiased belief. Anonymity has value. Understanding how people act and what they say versus what they do versus what they say do. So all of that is valuable information, and it can be used by professional traders to make better informed decisions.
How are the world's best algorithm trading companies and funds, the Citadels of the world,
all over it,
going to compete in a world where the average 15-year-old with OpenClaw or Claude is going to build a bot that does pretty much the same thing?
I'm a seller on that. I think good luck competing with Citadel for a long time. I don't care if you have Claude. I don't care how good you are, Claude. Until everything is run by agents, and even then, not all agents will be created equal. And I guarantee you, Citadel will have the best agents. Jane Street will have the best agents. So that's why I always tell be careful about day trading. You're up against, you're a sheep amongst lions. It's very, very challenging. Buy and hold, invest in ETFs. I don't think you can compete. I don't think you'll be able to compete. Whatever you have in your home, they have on steroids, and they've had it for longer than you.
Yeah. Okay. Fair enough.
There is this.
We're doing a Joe Rogan long form interview. All right, let's go.
Okay. There is this index that shows retail investor does not outperform the NASDAQ.
Right, we know that. By the way, 75% of hedge funds don't outperform the S&P. So that's not just
Well, what are people trying to do then?
I don't try to. I try not to judge. I mean, I think it's hope. I think they want to believe that they have the ability to outperform. It's ego. I think it's, why do people buy lottery tickets? Because somebody won, right? So, I think there's an element of, I believe in an element of freedom that everyone should be allowed to take that chance. I think that with a reasonable amount of your wealth, it's probably smart to do so, because we should all have hope. We should all swing for the fences with something in our lives. But in general, the average investor who doesn't have the ability to monitor markets at least 5 hours a day at minimum would do better off investing in pooled vehicles, Bitcoin ETFs, things like that. But I don't want laws that tell people what to do with their money. So that's why I shy away from restrictive laws about things like prediction markets.
My last question to you. You've got 2 kids, like you said. Would you encourage them to study finance?
So my 12-year-old daughter has a show on the floor of the New York Stock Exchange.
You're kidding, wow.
Children's Financial Network, where she interviews big investors, and she asks them how they teach their kids about money. So it is a constant source of conversation in our home. And I think the schools do a horrible job of teaching children financial literacy. And so I think it's incumbent upon all of us, not just in crypto, but in TradFi, to strongly encourage our children to find joy in this particular topic.
What is one rule you teach at home?
It's kind of nerdy, but I have a little. I moved it to cloud. I used to have a little spreadsheet on my phone that future value. So anytime we walk into a store and they want to make an impulse purchase, money should be for joy. So like, I don't want to be that look at everything, on the net present value basis. But if we walk into a store and we want to buy X and they say, oh, X was great, I also saw Y, impulse purchase. I make them put the present value of that impulse purchase into this little app now, spreadsheet, and it pops out at a 6% annualized return what that would be in 20 years.
Wow.
And I ask them, are you sure you want this? Because this is what you're giving up. So opportunity cost and future value calculations, they're super simple to understand, and it forces you to make smart decisions. So, sweetheart, would you like this? Or would you like $120 in 20 years? And we do it, we have it on my phone, and we do it all the time. And their kids are smart. And I'd say 80% of the time, they go, yeah, I want the 120 bucks. Sometimes they go, I want the toy. But that's okay. They're making an informed decision at that point.
I'd be curious to see how their decisions progress as they age. Maybe you can do it every year and track that.
My 12-year-old does it all the time. She does the math in her head now.
Yeah.
And she rounds it up and she says, you know what, this isn't worth it, Daddy. But now she tracks it, so I have to give her that when she's older. But I think just basic lessons in opportunity costs. What does it mean to take on risk? When is risk a good risk versus a bad risk? Kids are really smart. They understand this stuff.
Excellent.
Do you do that when you buy things too?
All the time. All the time. I think about when I'm 80, we all value different things. I value safety and security. I'd rather have the security of knowing the money's there than the shiny thing. That's my personality. I don't judge other people for how they think about it, but I think you just have to teach. That's a non-intuitive thing. That math is non-intuitive. And so I think you have to be taught that. I was lucky enough to be taught that at business school, and I think we should. These are not hard concepts. We put jargon around things to make it seem more complicated than it is. Future value versus present value is not a difficult concept. There's a meme going on that my daughter showed me about like your future self screaming because you're not studying. All the kids are doing this meme, and it's like it's sad. It's like it's funny to them, but it's sad to me. It's like a grown person like seeing their teenage self not studying for the test and like banging on the window. It's horrifying as an adult. The kids think it's funny, and I'm trying to help her understand why that's so popular, because it's speaking to a universe of people who wish they could go back in time and make those smart decisions, but they weren't given the ammunition to do so. It was unfair of them. It was unfair to expect them to do that. So that's what I try to teach. Not just my kids. I teach at schools, and I do as much as I can. And my daughter and I are working on a little YouTube video channel that we hope to push out just for that reason.
Called?
Children's Financial Network. We try to teach kids in fun ways using games we make on Claude, things like opportunity cost and all that stuff.
My last question for you is, you live in New York.
New York City, yes.
Yes. And people play...
That was a very obnoxious thing. That was when you ask somebody say New York and they go, I live in Staten Island, which I grew up in. I grew up in Staten Island, but New York City. I'm very snobbish there, yeah. Yes. What?
Do you ever play a status game? You have to up your car, your houses.
I grew up, my mom worked 3 jobs. My mom cleaned toilets. My dad worked 2 jobs. I remember when he used to come home from his first job, I used to be waiting for him with my baseball mitt, and we'd run out in the street and play catch. And I remember waiting for the street lights to go on and being very sad and anxious because I knew they were about to come on, because when the street lights went on, my dad had to get into his car and go to his second job. And so no, I don't. But I don't want to, I don't want to virtue signal here. I don't begrudge people who want to work hard and have toys. I didn't grow up like that, so it's just not important to me. But I have a status of like wanting my daughter to get straight A's. That's my status. So I pay for tutors and things like that. We all splurge on things. Don't judge. Find out what's important to you. Try to give back a little bit. It's the best you can hope for.
That was a beautiful ending.
Yeah, well, thank you very much. Yeah. And I encourage everyone to check out John's daughter's channel.
Oh, thank you.
What is it called again?
The Children's Financial Network.
Children's Financial Network. And also you were featured in the book Rigged, the true story of an Ivy League kid who changed the world of oil. We don't have time to go over that book, but
it was fun.
Yeah.
Fun
What
times.
was your? What was the
I
quote
was
there?
lucky enough to be in a place where I was tasked by the New York Mercantile Exchange to build the first ever oil exchange in the Middle East.
Yeah. Okay.
Yeah,
so
it was a blast.
check out that book. Check out his channel.
Cheers.
Check out our channel. Subscribe. Thank you very much for watching. Thank you, John.
Thank you.